what that competitive pressure, does to underwriting and rates and terms, and we're already seeing those type of low levels. Furthermore, on the lending side, we're just seeing pressure on the existing rollover from current books, right? Many institutions need a decent amount of net growth just to maintain loan interest income levels. For example, and I'll show you some tools today. I recently had an ALCO meeting, and we're really looking ahead into next year, into and looking at loan cash flow coming due, and loans are coming off the books around 4% coupons, and their average origination rates today on new deals are anywhere between 3.5 to 3.75. So they need to grow 3 to 4% on a net basis just to maintain those loan interest income levels, right? You throw in, the expectation for higher overhead next year, and then compare that to what we, are budgeting for loans, and you can see the challenges and really start to think about, should I be adding some insurance, right? Building some earning assets, as we go into next year. Real challenging discussions, but one that, it's keeping us up at night as independent strategic partners with our clients. And so that backdrop comes here, where there's just like this incredible appetite to really move the asset mix, to get out of cash and go into loans. And again, the last couple of years have been pretty strong earnings wise, and a lot of that has been propped up from the fee income. And now we're all looking at it, it's like, man, I got to grow some loans, and I got to get my cash to work. And again, I think that this could really challenge or maybe put a lid on loan pricing, even with rates starting to tick up over the past couple of months. I can see loan pressures and statements that we've been hearing and even talking about at ALCO is like, man, I don't know if I can afford to lose some of the best credits just based on rate and term. And that's obviously within reason, but those type of mindsets are out there. So the expectation is that the pressure on loan pricing will probably persist. Loan coupons have been coming down since Q1. Looks like we have hit a bottom. At least that's what our analytics are telling us. One reprieve that we may have here is the fact that market rates have come up. The 5-year point of the Treasury curve is up, 40, 50 basis points over the past few months. So that should start to lift pricing. But competitive pressures are gonna, put some, put a lid on that. So that's one early takeaway that I'd be going back to my team, say, hey, listen, are we getting an extra 25 basis points on some of the deals that we're working today? And I know there's a lag period, on lending and loan pricing. But I think that's something it's going to be difficult, but we have to push. This recent yield curve shift is providing opportunities, especially with, those of us who have, a lot of excess cash. And if you look at, the spread between the 5-year and the 3-month Treasury, it has obviously widened out over the past quarter. It's like, now some institutions are like, all right, I see this big earnings gap going into next year, but, now I can pick up 125, 150, maybe even 175 basis points on cash, depending on different bond packages. So I'm going to explore that a little bit today and look at a couple of different opportunities, weighing the pros and cons of something more conservative, providing near-term cash flow with the expectation of rates going up versus more of a barbell strategy, and talk about those opportunities. It might be a good chance to get, again, some momentum going as we enter a difficult year. Flip into the funding side of the balance sheet. There's still uncertainty around all this deposit surge, although there's that is slowing down. One of the most popular questions that we get from our clients is, what are you guys seeing for deposit surge runoff? We're not. It's like the opposite, right? Deposits could continue to grow, and we're just not seeing any signs of that. And again, up until data that we've collected through September, we do a lot in deposit analytics. We have not seen any signs of changes in customer behavior patterns, particularly with spending patterns. Now, this data is being captured through September, and we know that the unemployment benefits have been walked back, right? The stimulus, a lot of the stimulus packages have come down now. And so that may change, something we're going to be closely watching over the next couple of quarters. But you get the sense out there that a lot of institutions are saying that these deposits are going to stick around for a while, and that's going to help influence what we do with this excess cash. And then finally, there is a natural fear of asset extension, and rightly so. We're in a historically low rate environment. You got all these inflation, fears. The market's now building in 2 Fed hikes going into the back half of next year. I get it. With that being said, I will probably talk about asset extension a bit today. Okay, a bit. And it's not because I'm trying to pitch you something. We don't sell bonds. We're not investment advisors. We are 100% independent. And I'm not trying to speculate on where I think rates are going. That does me no good. It's because we're risk managers. And the biggest risk to say most, if not all, of the people on this call to their earnings is if longer term or intermediate rates stay down where they're at or go even lower. That's the biggest risk, right? And so in dealing with that margin pressure today, and that's a tough one. It's like, how do we weigh this margin and earnings pressure in this current environment versus the backdrop of inflation and the Fed, going higher? And we've got to talk about that at ALCO, right? And coming back to the asset extension, it's like, all right, there's not much I can do, to squeeze on the funding side. So it does come back to the asset side. And so we really got to figure out what our comfort levels are, especially with what's been going on in the belly of the curve. And those are real challenging discussions, but I think we have to have challenging discussions at ALCO. So that's a lot to unpack for today. We're going to get into it. Where do we start? Well, it starts at ALCO, and I guess this is where our bias does reside, but it works, right? And we've got a couple of mantras here at DCG for whatever that's worth. Number one, let's make ALCO a profit center. The minute we look at ALCO as something that we have to do or just a check the box item, for the regulators, we are leaving money on the table. And I'm going to bring that to life today. And number two, listen to our balance sheet. And that's tough today. Are we making decisions based upon what we think is going to happen or our gut, or are we making decisions based upon our risk profile? And we can blur lines there, right? We have to. The Fed is very transparent, right? I'm okay with blurring lines, but that's a very difficult, notion. I think it makes ALCO, challenging. But we'll talk about that today. So our whole, ALCO philosophy, little hokey wheel we have here is that, listen, anybody can build a model, right? Anybody can put together a report. How do we take ALCO forward thinking and leave the meeting with executable strategies? Okay. So with that, where do we want to start? Well, let's start at the ALCO meeting, and then we'll work our way backwards. 6 steps to reframe the ALCO meeting. And this slide came to me actually a year ago. I had a first-time ALCO meeting with a client, and we built the ALCO model from scratch. We actually did a pretty in-depth deposit analysis. We had a pre-ALCO strategy call with finance, ran a bunch of pro formas on different strategy ideas, had the first meeting set for about 90 minutes. I got a call from the CFO the night before. He's like, Joe, we got to do this ALCO meeting in 30 minutes. I'm like, Craig, 30 minutes? Like, we put all this time, energy, and effort. Like, you're not going to get your return on investment in 30. Like, why 30 minutes? Joe, 30 is the stopping point. Anytime after that, people lose interest and they fall asleep. I go, Greg, I get it. Give us this try, in the first go around, and we can readjust as we move forward. The ALCO meeting went 3 hours. And it had nothing to do with going through, reams of paper. In fact, the deck was only about 35 slides because we rolled up our sleeves. Everybody was involved, people from the front lines. And we left the meeting with 3 executable strategies that really changed the trajectory of the balance sheet. So let's start your ALCO meetings with the key issues. Rather than saying, balance sheet did this, loan and deposits are here. What are the key things that we want to talk about today that lead us to a point of strategy execution? So for example, I had an ALCO meeting Tuesday, and it's a client that, my main key issue for them is that I really wanted to reassess their interest rate risk position, given the fact that like a lot of other banks, they've been adding fixed rate assets to their balance sheet over the past couple of years, holding some fixed rate mortgages, adding duration on the investment side. Yet their sensitivity to rising rates continues to improve. It's counterintuitive, right? And so it's because of all the deposit growth. And so we needed to have that discussion for 2 reasons. Number one, we need to do more. Right? We need to do more of putting some of our cash to work out on the curve. And I wanted to have, make sure the team had confidence to do that and understand how far out on the curve we wanted to go. Number 2, in preparation for if the Fed does tighten. We've had all this deposit growth. And so what do we expect for sensitivities in terms of, Fed going up 50 versus 100? And so at ALCO, we talked about a lot, right? But if we keep that narrow focus, it's going to get us to a point of strategy execution. Condense the deck. We're all all guilty of this. These ALCO reports have gotten really dense over the years, and it's really because of the regulation. It doesn't mean we have to go to the ALCO meeting with a 90-page deck, right? We walk away 90 pages, people are, the meeting's over before it started. So here's another takeaway. For your next ALCO meeting, target about 30 to 40 slides for your presentation. Okay, that's what we try to do for our ALCO meetings. And I'll give you some ideas of what you can crop out to really condense that down. Initiate discussion. I know we've got some clients on the call here. The best ALCO meetings are, of course, the ones where everybody's involved, right? And we need to hear from the frontline folks, right? I need to hear from lenders today, because depending on what the market is telling them, we then react as risk managers, right? I want to know, like, hey, is there a lot of demand on 7 and 10 year deals, right? And if so, how are we responding? What's our pricing, minimum of what we're looking to do there? Give me some ideas of loans that you said no to. Why was it based upon, the credit underwriting? Was it based upon the rate of the term? And what are we saying yes to? Same thing on the retail side. If you think about 17 through 19, a lot of the ALCO meetings were driven by, funds management and retail in terms of product positioning, rates and understanding cannibalization. And that's going to come back into the fold in the next couple of years. Let's listen from them, right? What's going on in the marketplace, and then we can react in how we manage the risk. Run pro formas. Wouldn't it be nice if we could say, let me take half of your cash position and go put it to work out on the curve. And let's look at it, a few different ways. Let's have options, right? What if we did, a bucket of commercial real estate loans, or we held, more, instead of selling 70%, we sold 30%, right? We hold more fixed rate, mortgages. Or let's look at different bond packages, maybe a barbell strategy versus a more conservative, duration initiative. And then, really analyze the impact to each one of those. And I'll show you actually examples of all of those today. Target an allocation that focuses more on the strategy and forward-looking piece, and less of what's behind us. And that's hard to do. I think that's an area where we can provide a lot of help. And then finally, let's tell a story. I've always looked at ALCO as, trying to tell a story. It doesn't have to be the same old boring stuff. What are the key issues? What's the storyline today? And let's take our team on a journey with us. So with that, let's have our own little journey for today. The first stop is really framing the challenge for your ALCO team. So the storyline, of course, being able to quantify margin pressure. So here's another takeaway. At this point, you probably have a pretty good idea of what your net interest income levels are going to be for 2021. Look at your interest rate risk model and what you're projecting out in 2022. Okay, base case, no growth, no change in rates. For most of us, that's going to be a negative delta, right? And so start with that number, what that gap is, and then that'll just, that'll have the conversation take off. Let me give you an example. So, this whole, idea has really been the nucleus of our ALCO meetings this year. So here's a client that I work with. This is our NII simulation, 5-year sim. We build it out in graphs. The bar graphs represent the base case. So no growth, no change in rates. And I know a lot of us like to build in dynamic, modeling and pro formas and forward curves. We like to do all that stuff as well, but I like to start here. Tell me the natural rollover of asset yields and liability costs, because I want to see what I'm up against. Okay. And that's what these bar graphs are showing you here. The other scenarios for completeness here, the dark blue -1, that's a scenario I hope we never see again. And then the up to ramped is the orange. Okay. But really concentrating on one issue at a time here is really trying to quantify, again, what that hole is as you kind of prepare for 2022. And I know a lot of you are now kicking around your budget. So for this particular client, the give up in NII was about call it half $500,000. And now we can start to, we got into, put it into context. Now we can start to say, all right, how do we, fill that gap, so to speak? First on the bond side, like, let's just, throw some numbers out there. We need $42 million of cash extension at a 125 spread. Okay. Most of us don't want to be there today. I get it. Totally get it. We want to be on the lending side, right? They need $17.5 million of loan growth at a 3% spread to cost of funds. So the good news here for this particular institution is that's about a quarter's worth of loan growth. The bad news is that it's a quarter's worth of loan growth just to maintain, right? And then what else do we have to squeeze on the deposit side? And you still have room, I know that, but you got probably 3 basis points here, 5 basis points there, and you're going to get there. So the point is, You're doing all of this, right? I understand that, but when we can put a number to it and frame the context, I've seen it change the conversation. Like, man, that's a big loan number, right? Maybe I should start holding more fixed rate mortgages, or that's a big loan number. By the way, I haven't even talked about investment cash flow coming through next year that I know I'm going to have to reinvest. Maybe it's time to do a little pre-investment strategy, right? Or I like what I'm seeing here. Maybe what if I do 150 on the bond side, real quick hit, because I like this, you get it, right? And so it can really change the conversation. Here's another tool. We're always trying to, develop tools to help support decision-making. And this is one that you can recreate, it's actually pretty simple. Here's a client that looking at their loan cash flow coming due over the next year. And so I gave the example in my opening. So they've got $400 million of loans coming due at 386, a weighted average coupon of 386. Okay. Well, they're putting loans back on the books around 3.5 today. Okay. It's actually a pretty even mix between resi and CRE. And so you can see here, they need, anywhere between 4 and 5% growth at those levels just to maintain loan interest income. Okay. Now, I know these folks, they're budgeting 5. I know they'll be at 6 to 8. But it's like, so maybe there's not as much pressure to get aggressive with duration on the investment side. I've seen different ones where it's like 8 to 9%, and CEOs like, I'd be thrilled if we get 5, right? So, all right, now we know what we need to do on the investment side, or other loan. I know there are a lot of partnering with fintechs and loan participations and buying different loan pools, right? So maybe it puts more emphasis on those strategies, right? Got to frame the discussion and then let the conversation go from there. Now, in doing this, naturally, the conversation comes back to interest rate risk. So to avoid getting too bogged down in interest rate risk, again, what's the story that I'm trying to tell? I want to quantify my ability to extend assets. Even if you don't go there, I think it's healthy to get a number. And then interest rate risk positions have changed quite a bit post-COVID, quite a bit. And if it has for you, I'd want to tell that story. Do we think that's going to be here to stay, or is that just a short-term thing? In telling this story, you got to have the right tools. And I'm very fortunate, again, where I get to do little strategy sessions with prospective clients. And a lot of times, I see that the finance team isn't fully equipped with the toolbox to really tell their story, right, to their stakeholders, whether it's senior management or the board. So here are some things. It's kind of out with the old, in with the new concept. Here's some ideas if you're still looking at interest rate risk in this concept, just a couple of ideas to build on that. Okay. So number one, if you're just looking at a 1-year analysis, open up that window, right? Especially today, if we're talking about strategies out on the curve, I want to see how it impacts the whole risk position, right? I want to, most of your assets, I'm assuming, reset or balloon outside of a year. Open up that window. If you're just looking at percentage change, hey, I got a 2% exposure to rising rates in the first year. Well, is that all in the, first couple of quarters? Is it on the back end? What does it look like in year 2? Is there a good recovery? Focus on shocks. I know we have to run shocks. And I even know with, the inflation, perspective, but it's still going to be tough to sell me on a shock up 2 or shock up 3 scenario. And I see, areas of focus there. Most likely scenario, I'm not against. I would rather have that as a pro forma, though, rather than in my base. I've seen most likely look good and then never come to fruition. And then gap, well, you know what they say about gap. So, build out graphs. They're pictures. They tell a story. You can see trends and inflection points and how things, trend over time, and longer term graphs, pro forma simulations. But the point here is to do the pro forma simulation in context of the whole balance sheet, not just an isolation of a transaction. I'll show you what I mean there. That brings clarity to different ideas. If you do a strategy that may sound large from a notional amount, but it's only 4% of the balance sheet, it's probably not going to move the needle from a risk perspective. Earnings over EVE, I probably don't have to defend that. Ramps over shocks. And the point here is that in the ALCO meeting I had on Tuesday, it was an hour 45 meeting. I didn't spend more than 30 seconds on EVE or shocks. Right. So those are the things that we can crop out. They're in there, right? In policy. Okay, let's talk about what's next. So when I come back to the capacity to extend, again, I'm not trying to be a cowboy here and say sell the farm and go all on the curve, and I'm not trying to sell you any bond. It's just not what we do. It's just that it's been coming up time and time again in almost every ALCO meeting. So here's a little playbook of things that we can look at to tell our story. This playbook will change probably 6 months from now. Number one, if your risk position has changed a lot since March of 2020, we got to defend that, right? We either got to defend it or we got to, have some explanation behind it. Is that the new normal? Is it, temporary? Now that will, eventually come back to the discussion on deposits. And we don't get into deposit analytics a lot at ALCO. I think we need to today. And so really understanding how sticky for how long do we think this deposit surge is going to be. And I've got a little workshop of things to attack on the deposit side in a couple of slides. Understand the dynamics of this is critical today, right? A parallel versus a yield, flattening of the yield curve. We started running this a couple of quarters ago, and I think it's real important today, especially with the market, expectations on Fed rates. So just kind of juxtaposing, like, all right, what if rates go up from a parallel standpoint versus what if rates go up right and the yield curve, flattens? We know, well, history will tell us that when the Fed starts to tighten, the yield curve, does flatten. So when I'm running strategies today, I've got a little bit more focus on that scenario than I do a parallel shift. I look at both of them, and it does tell a different picture. I did a cash extension the other day, and it does tell a different story. Got to look at that. What did you learn from the last rising rate cycle? And what do you think the reaction is going to be for the first 50 or 100 of Fed tightening, right? You got to look at that. Our data, tells us that for, if you go back to, I'll actually show you the chart, for the initial Fed tightening, there's just an incredible lag period. So what does that mean to you, right? Everybody's different. Given how much liquidity is in the system, maybe there's even a more lag, right? You gotta, what's our expectation? Because I want to talk about that in the context of, okay, if the Fed does go up 50, what do I think my funding cost adjustments are going to be going at the end of next year and into 2023? And then quantify your core base and what it can support for long-term assets. So I'll show you examples of some of these here. I'll come back to this deposit one. So, this is our deposit data from our Deposits 360 module. What I boxed in here was, it's basically 16 through 17. And the black dashed line here is the effective Fed funds rate. And that's the first 100 basis points of Fed tightening. The blue line is the average money market rate. So, what you can see here is that over that 2-year period for the first 100 basis points of tightening, deposit rates didn't really move all that much, right? They didn't. So if, again, we're talking about in the concept of, we don't think rates going to move for another year, right? And when they do for the, if it's going to be another slow moving Fed, and we have that lag period, does that change what you're going to do on the asset side of the balance sheet today? Action items, go back to 17 and 19, 16 and 19, whatever you want to look at. What were your betas? Different products, change in mix. How much did you lag? And start planning for the next cycle. Right? How much do you think you can lag? Here's a good question to ask your team. If rates start to go up and we lag, and we start to see some surge runoff, how much are we comfortable letting go out the door before we actually make a move with pricing or a new product? That's going to be a tricky one next year. Another easy takeaway to incorporate into your ALCO. This is a simple tool, but it gets a lot of great feedback, is looking at, long-term funding versus long-term assets. And so here's a client that has long-term assets, $77 million. Is that good or bad? Well, it depends, right? How do we fund those long-term assets? And if we look at the good stuff, checking, savings, capital, right? The balances and the products that continue to grow are non-rate sensitive in the tightening cycle. They've got 241 million of long-term core funding. So they're not even utilizing a third of their long-term core funding to support long-term assets. Does their balance sheet support long-term assets today? Yes, right. And so that's, again, another easy one to add to your reports. Rising rate. Well, what rising rate exposure? And I did this simple analysis. I did it in the beginning of this year. So this is from last year's data, but it still tells a story. And so I looked at, we run, well over 325 models a quarter. And so I looked at our bread and butter scenario, up to ramped NII sim, year one change. I went back to March of 2020 before everything kind of, the balance sheet shifted a lot. The average sensitivity was minus 0.8%. So slight sensitivity to rising rates for all of our clients. by the end of that year, so just 3 quarters later, it was positive 1.4. So there was over a 2% delta in sensitivity change. You generally don't see those type of movements so fast in our space. And this doesn't even include the first half stimulus package, by the way. We saw a 60% increase in asset sensitive profiles. Like everybody's asset sensitive today, right? This is strictly due to all the non-maturity deposit growth. That's it. It's that simple. Here are a couple of examples. And I know these are just obviously specific examples, but I think the pictures tell the story. So this is a client. Over to the top right was their risk position, NII position at the end of 2019. To the left was their risk position 2020. So if you look to the top right here, what I've circled, they have that kind of that conventional community institution rising rate sensitivity, where they don't have a lot of floating rate assets, but they don't have a lot of really long-term assets. So you get a near-term pinch and then the recovery. Look at them now. They look like a CNI bank, right? Here's another one. Over to the bottom right here, this is a classic liability sensitive profile, right? The orange line, again, that's the up to. You can see it trending lower. Look at them today. Well, this was actually end of last year, but well matched to like asset sensitive. So we're making decisions off of these risk profiles. Do we trust them? Do we trust them? And to answer that question, or at least give us some guidance, it comes back to the deposit side. Again, we don't spend a lot of time with deposit data. I think we have to today. So the storyline, for your group is, quantify the surge magnitude and identify where that surge sits on your balance sheet. And that'll give you some clarity on the stickiness factors. Let's first set the table of what we've seen for deposit activity all the way through, I think this is August. This is our client data from our Deposits 360 module. We got 225 clients throughout the country, billions with a B of data points. So these are very consistent with national trends. But I'm going to show you some trends that you can't really get out of call reports today. The blue represents, these are monthly, flows. The blue represents total deposits, orange is non-maturities, and gray are CDs. So of course we got to go back to the great spring surge of April of last year. To put that month into context, we as an industry effectively grew a year's worth of deposits in 1 month. We know now most of that was business. There, of course, was consumer, growth as well. Some of that, kind of bled into May. But then as you look the rest of, through the rest of 2020, we were still net positive deposits throughout the year. Businesses investing less, people spending less, pretty simple. If that wasn't enough, we had the big pop in the stimulus surge in the first half of this year, which we know, of course, is more consumer related. By the way, during this whole, actually it looks like every single month post-COVID, look at CDs. CDs have been, in a net decline. And so here's another takeaway. If you had a, somewhat meaningful CD book pre-COVID, it's imperative that you understand how many of those CDs shifted over to non-maturity deposits. We track that in Deposits 360. We track cannibalization. It's important because those are going to be the first funds to move in a tightening cycle. So I think that has to be incorporated into your risk position. We did see a little bit of a flattening in I guess late spring, early June, and then growth has been back up again. You got child tax credit absolutely feeding into that. So again, not seeing much in the way of balances leaving. Let me get you to the next layer actually. So these may just look like squiggly lines, but this is a pretty interesting analysis here. This first is just looking at business deposits. Okay. And we're looking at relationship flows. So accounts rolled up at the relationship level month to month and breaking it down through a couple of different trend lines. So the solid blue would be existing relationships that each month show net positive. The solid orange are existing relationships that show net negative. Okay. The dashes are, blue dashes are net new accounts, dollar flows. And then the orange are closed, relationships. So that would be, a first, point of talking here where you can see April, there was that spike of new relationships. That was the home run story in 2020 of how great we did as an industry and the community side to really support, the PPP activity. And so that would be worth exploring. Right. So one thing we look at in Deposits 360 is we say, okay, show me all the new business checking accounts that opened up in April of 2020. What do those relationship dollars look like today? Have we been able to really expand on those new relationships? I don't care how much we have in deposits and how much we have in liquidity. It's always a good time, right, to be growing core accounts. But outside of that month, the trends for new account growth is just, consistent with historical trends, which tells us what? Most of this growth is really from existing relationships. And so if you kind of look at this, how the trends are, the spikes, outside of 1 month, which is December, and I think there's some seasonality there, existing inflows have outweighed outflows. So there's that net positive, trend line. And again, look at the orange line. It's not showing any signs of taking off. So for business deposit relationships to really to go down, man, we'd have to see this trend line spike up a lot. And for a while. Let's go to the consumer side. Similar type of storylines here. Same exact trend analysis. You had the big pop last, every month, right? Every month outside of looks like the spring of this year, where spending did pick up a little bit, but every month, and even things are pretty balanced, here. So on the consumer side, more so than the business side, most of this deposit growth, for the industry has really occurred on the existing relationship. So average balances are a lot higher, and you know that. So what do you do with all this data and start to tell your story? Well, a couple of action items. Number one, quantify what you consider to be surge. Okay, even if you grew 30% since March, well, what did you expect to grow? You probably had some expectation for growth. If it was 8% or 10%, what's the delta there, and what's the number? By the way, you're going to need that for your sensitivity testing, and I'd keep it in my back pocket for the regulators. I'm starting to hear some regulators ask for that surge, number. Identify where it sits on your balance sheet. Consumer, business, public, different balance, tranches. The point is, we're trying to to gain as much intel to then say, well, what does it look like at the end of next year? Beyond, right? And that's very hard to do, but we have to start that conversation. Here's a benchmark to work off of. This is our surge analysis in our Deposits 360 module. This is an average for our clients. The gray represents balance trends. This blue line, we've got a really neat forecasting module that's actually a bottoms up forecasting tool that looks at individual account attributes like size and rate paid versus competitive benchmark and vintage, and can project out balances. Well, we were expecting deposits to grow, and that's where deposits ended up. So as of July, the average surge, non-maturity deposit surge count that we had for clients was 20%. There's your benchmark. Okay. Now that's not suggesting that 20% is going to leave. That's just saying that's abnormal growth versus what was projected, right? So, again, start with that number, and then we want to try to solve for where does it go from here, right? Do balances continue to grow? Because that's been the trend this year, or because stimulus packages are ending, is this kind of the new normal, or are we going to start to see this thing trail off with more spending habits? And that's tough to tell. And so I think by bringing some clarity to what surge means for us can help tell that story. So some more action items as you get into it. Simple one. Segment out your growth by, how many new accounts versus existing accounts. And so again, I mentioned that outside of April on the business side, most of the growth that we're seeing overall has been from existing relationships. So like, I want to know those accounts. Actually, an easy one would be, what is the average, the average balance size change over the past 18 months? Right? And then you can break that down by different products and cohorts. I talk a lot about, understanding growth by balance concentration. If most of your growth is happening in, 250 and above, you're going to have a different assessment of stickiness factors than if it was, in the, spread really throughout the deposit base. That should be a simple one. Break out business versus consumer. I'll give you a case study there. And start at the top, right? Start with your top 20, top 50, top 100, and then you can start telling a story there. So I want to bring a couple of those items together in a case study. This is just an example, client I work with, breaking out consumer versus business versus public, and also balance, tiers. And we like to do that because in our industry, we blow the whole 80-20 rule out of the water, right? We're like a 90-10 or 95-5, where the majority of our balances are controlled by, a select few of depositors. And so I want to see how that makeup has changed. So these are just different tier tranches, and looking at deposit growth since Q1 of 2020 for this client, they're about 2.4 billion. So 236 million of their growth was on the consumer side. But look at this, right? It really spread throughout, different tiers. And so that was interesting to us. And again, most of this it came from existing relationships. And so from our perspective, it's like, man, it would take a palace revolt for a lot of these balances to leave in a material fashion. Good. That gives us a starting point. The story changes when we go to the business side. 90% of all their growth, 300 million, occurred in accounts 250 and above. What I saw with them, and I see this frequently, is that they had a lot of small, average, smaller, business checking accounts that double, triple, quadrupled in size. I'd like to get that list, right, and tell a story there. Publics, if you're involved in public, those are select stories that you know about. But again, breaking out the different sectors can then give you more of a, kind of a plan, maybe, right? Something to explain to your ALCO and say, all right, well, I've had 80% of my growth here in 250 and above, but as I break down the sectors and I tell a different story, I can now start to discuss stickiness factors. Start at the top. This is something that's a good takeaway here. Look at, this is top 20 list of the largest deposit growth that just looked March to March. And these are all multi-million-dollar accounts, but more than a handful had less than $500,000 pre-COVID. And so it's like, oh, that's interesting. So who are they? And so these are a couple of depositor profiles. This is from our D360 modules, like small, low, or low average balances, and then all of a sudden you've got a big pop. So we use the whole pizza party analogy. It's like, let's get a list of the top, right? Top, biggest movers and shakers, get our team, relationship managers in a room for an afternoon and just go through that. Who are they? Business versus consumer. What do we know about their relationships? And what do we think, right, is going to happen? What do we think the average balances really look like over the next couple of years? Because ultimately we're trying to get here. Right? I'm trying to deal with, and it comes back to, I'm trying to deal with margin pressure. And I'm trying to figure out, how sticky these deposits are going to be, or what deposit and cash levels could look like 6, 12, 18 months down the road. So I know this is like nearly impossible, but we have to start somewhere. And one thing you could do, and we try to simplify it, is to compartmentalize, like you've got surge, right? You got PPP, you got stimulus funds, and then you got your deposit base. Now build different assumptions for each. So here's an example of, we do some of this, surge forecasting in our tool here. I'll give you, a 3-step, case study. Scenario 1 would be 25% surge. I should say surge runoff. So if surge was 20%, we're going to run off, a quarter of that. And I'm going to do that over a year's time here. And that's the blue dash projection. So you're going to see that even with the runoff, the growth projection goes higher. Right? And the fact there is like, okay, even if we finally see some PPP deposits go out the door, we're expected to have, organic growth from our core deposit base, offset that. And that's an important concept. From there, we can go to the extremes. We like to go to the extremes and then work our way back in the middle. 100% surge runoff. We're not seeing anything in the data that would signal this. That's the red dashes. You can see the precipitous decline. But even again, balance sheet within a balance sheet concept, the endpoint is still basically the starting point of this year. And then we went to scenario 3 here. We had the baby bear, the papa bear, we go to the papa bear, 50%, surge runoff. So this would be kind of a stress on the base and say, what, I'm not seeing it, through this year. Maybe it, ticks up going into next year. So we delay it. So you can see it uptick a little bit and then go down. And so again, I'm trying to get a band of potential outcomes. And you can see in scenarios 1 and 3, it's like, yeah, it could lead to some deposit, sensitivity, but the balances are pretty still close to where they're at today. So if I've got excess cash today, I know my loan, budget's not going to eat through that. In this case, I know I'm going to have excess cash, down the road. And hopefully that, again, gives more confidence in some of these strategies. So a couple of initiatives, 3 of the things that we talked about: quantify your pressure, tell your deposit story, forecast out potential cash levels, and quantify capacity to add fixed rate assets. I want to come back to the bond side. And when I say consider bond extension, really what I'm saying there is like, don't just willy-nilly go out buy bonds. It's like, well, what's our story telling us? I got the margin pressure. How much loan growth am I expecting? And how does that then, feed into that pressure, the earnings pressure, right? What do I have? I would like to know, what do I have for investment cash flow coming in over the next 6 to 12 months, right? And if I've been building up a bond portfolio and I got a lot of cash flow and I know I'm going to have to put that cash to work, maybe I'm even thinking of like a little quasi pre-investment, idea. And so then if I'm thinking about that, let's kick around a couple of different strategies. I know a lot of folks out there want to, have some good cash flow and be a little bit defensive because of the idea of rates going higher. Obviously, that's going to take away from some of the spread. So I'll show you a couple examples. I think one important thing, and this is a really like a sidebar discussion, but because there's been so much bond buying this year, we got to be prepared to tell our story on potential unrealized losses. Okay. And so there's a whole discussion that you can't, it's almost like a whole webinar on what that looks like, what it means. You got the discussion on tangible capital. But I think this is important, right? And I think, a lot of us will think of, unrealized losses aren't necessarily bad. It's like, there are a lot of unrealized losses in 2018, and my margin was about a point higher than where it is today. So what is that telling us in terms of where the market is, loan demand, expectation for future margin. On the lending side, I think just changing the loan conversation. I got a question here. We're going live here. What are your thoughts on putting a portion of the bond portfolio in held to maturity? I think it's something you have to consider. That particular strategy is very, on a case by case basis. It's like, okay, I need a publicly traded bank. Are we talking about muni bonds, right? We talk about bullets. We talk about MBS. What are the risks of doing that, right? Why are we trying to do that? I think it should be part of the conversation. I think you absolutely should explore it, right? So I think that's worthy of you asking that question and talking about it at ALCO. So on the lending side, sometimes we'll even say it's like, hey, let's just start like maybe, can we afford to lose the best credits based on rate and term? Right now, it's obviously an aggressive statement and it's within reason, but kind of starting there, because if we're saying no to a deal because I don't like 10 years at 3 5/8, then what are we saying yes to? And I'm talking like pristine best credits. Okay. So I think just kind of talking about pricing, when rates were lower, it was really important to look at pricing, not so much on an absolute level, but on a spread level. It's like, hey, I'm not going to go below 3.5% on a commercial real estate deal, but 3.5%, versus like the home loan bank or the swap curve was still at a higher spread than we saw pre-COVID, right? And I know we had to price in, higher spreads because of the credit uncertainty, but you're just getting down to that level of discussion and revisiting hold versus sell. And I think there the discussion is, it's like nobody wants to do that, especially with real estate values, so I should say nobody wants to do that, but real estate values so high and the fact that coupons are low and so obviously there's a real challenge there. One thing worth analyzing is the break-even analysis. It's like when we were selling mortgages and spreads were a lot wider, it's like, man, if I hold a loan, it's going to take me 2 years to recoup that just in terms of interest income. That's been tightening up. Right. So what's your break-even analysis? And does that change? Instead of selling 70%, I sell 50%. Right. So I think the most important thing in this section is that because we have difficult decisions today, we've got to document these strategies, right? Because we have no idea what the future holds for us from a rate perspective. And so here's this is a simple one, right? One that many institutions are considering. Do I again change that, holds for sell allocation? So this is just meant to give you some examples. So here's the strategy. Why are we talking about it? Well, what's more important today? I'm having a good 2021. I'm trying to build up, annuity stream for 2022, right? So what's more important, the fee income today? And then what's that break-even analysis? If it's still 2 years for you, then, that might lead you, that might give you your answer, right? I like the idea of filling a bucket. You know what? Let's take the next night. Let's fill the next 5 million. Right? Or 10 million. By doing ALCO and having these conversations every 90 days, you're never going to get offsides from a risk perspective. Okay. And then what are the results? It's like, here's a controversial statement. This strategy might actually protect your interest rate risk from a sustained low rate environment versus, rising rate exposure, right? Of course, it's going to change that position. I talked about the break even, and then what are the risks? Everything we do has risks. Not having this conversation probably has the biggest risk. And then modeling them out. And so I mentioned earlier, not looking at the strategy in isolation from a transactional standpoint, but as it envelops into the entire balance sheet. So here's a client that I work with, classic asset sensitive, right? Orange line goes up, that's rising rates. Base and falling rates are the biggest concern we have for them. And so we're like, all right, let's consider that. Let's just say, let's get aggressive. Like, let's just get it start, go to the extreme, and then we'll work our way back. Let me do, $20 million from cash into mortgages, something like that. It's like, and this is within 5% of their total balance sheet, this number. And so you might be looking at it and say, well, it looks like the same graph. That's the point. It's like 5% of your balance sheet notionally might be a big number, right? But 5% in context of the rest of the balance sheet most likely won't change your risk position. So it's like, okay, I can give myself a stronger footing going into next year, and my sensitivity doesn't change. Right? Bring the strategies at the total balance sheet level. There are a ton of variables, right? So Joe, these loans are going to be on the books way longer than historically that you would see. Yeah, that absolutely could. There's so many different variables. I think the biggest variable though is what happens with deposits. It's like, I'm going to be the sole reason by holding fixed rate assets that deposits start to leave, I get crunched. And so like, let's talk about it. And so this is just a, same base scenario over to the right, over to the left now shows the mortgage growth coupled with, I ran off 20% of their non-maturity deposit surge. It's unlikely. There's a low probability of that happening. So it's more of a stress test on a strategy. But even if that were to transpire, they don't flip to liability sensitive. The orange rides right along the bars, so they're well matched, and then they get their longer term asset sensitivity. Got them to a point to feel comfortable saying, okay, I'm not going to do 20. Let me start with 7. And so go to the extremes, and then we can work our way back. I talked about the bond strategies and the opportunities from the recent sell-off in the belly of the curve. These graphs, I mean, you don't have to. You can analyze them afterwards if you're interested, but I wanted to look at this, 2 different ways, and we don't have a bias because we don't sell bonds. But I wanted to look at it first from the perspective of, I want to get some, near-term cash flow going for me, especially if rates rise. So more of a conservative, shorter duration bond package. I purposely did not put the specific bonds in here, okay? Because I'm not here to give specific recommendations on bonds that I like, okay? It's going to be different for everybody in your risk position, and it could be different tomorrow than it is today, right? So the point is to where are we at today? What are we looking at? Let's run those through the model. How does my risk position handle it? What is the impact of earnings, interest rate risk, liquidity? And then let's compare that to some alternatives. That's kind of the focus of this. So this was a $25 million extension. I did look at some short bullets, some short, amortizing paper, some pass-throughs, and you can see down here in the base, the difference in results. So the strategy adds about $250,000 of pre-tax net interest income. Okay. Positive in the downs, in the ups, you can see in the up 2, in the flat up 2, there's about a negative $200,000 delta in year 2, right? So, rates go up fast, and immediately, obviously this transaction would be, underwater, so to speak. So, okay, then I want to look at it and say, what if I do more of a barbell? Right? What if I keep more of my cash, powder dry, right? And I take a smaller bite, but I go further out on the curve. For some of you, that means muni bonds. For others, it means dust bonds. It means lower coupon MBS paper, right? And so there's a combination of that in here. And so what I found is if I still want to get the $250,000 of pre-tax net interest income going into next year, I only have to do 16 million versus 25. Keep more powder dry to hopefully fund loan growth. Take a look at the results. Look at the up 2s, the flat up 2 and the parallel, right? Basically neutral. So in other words, there was less net interest income dollars at risk in the longer duration, barbell strategy versus the shorter duration, which sounds a little counterintuitive. It's because of, the shape of the curve and amount of bonds, obviously purchased. So I think just saying, all right, let's put these ideas on paper. I like this, I like that. And let's, all tell a story of what it means and how we're planning for next year. And let's get to a point of strategy execution. this would probably be more of a tear sheet that you could pop into your next ALCO meeting. These are client averages of, commercial real estate loan originations over the past 4 years. The blue bars represent the originations. The maroon, I'll call it, or the red are the average coupon levels of originations over time. The green is just, I use the 5-year treasury rate, and then the purple is the spread. Okay. So what you notice, and this is up until probably the last month or two, the purple line really has increased, post-COVID, right? So we had, obviously spreads widened out, okay, for good reason. And then since then, spreads have been tightening. And you can see that from, in August at least, that, even at these lower coupons, spreads were still materially wider than where they were pre-COVID. And so that was my discussion on how are our spreads. That would be a good takeaway, right? Where were you pricing, where are you pricing today versus, a couple of years ago? And how do we have that discussion rather than absolute rate level, but a spread level? The conversation, of course, has pivoted in the last month or so to say, all right, now that the 5-year has ticked up even more, has our loan pricing reacted? And if not, how do we get it up a little bit? That's going to be real tricky. And then my last slide for today, on the deposit side. So this is, I'm not coming in here, banging my fist saying you got to lower deposit rates, we're pretty close, to the bottom. And what you're looking at in this heat map these are money market accounts, all the accounts that we gather from clients between 1,000 and 100 million. So capturing most money markets. The blue dots represent the average money market rate along that balance structure. So you can see for $500,000 to $1 million, average rates are around 20 basis points or so. Again, how much lower, you're going to go. What was interesting is that there are still some clients in some accounts, that's what this heat map shows, that are still pricing, whether it's exception or public funds, that are still pricing above that. So the point here is, because non-maturity deposits represent such a large base of your funding today, it's really large, even a couple of basis points makes a difference. Like, what am I talking about? A penny or two here? Well, here's a good takeaway. What if you went down, 5 basis points on your money markets? What would be your cost savings for next year? And then what I'd like to do, shape that in terms of, how does that come into context versus what would I have to do on the investment side? So for one of my clients, they still have some room to go. I'm like, you can drop rates here, right? Or you can do $30 million of cash extension. What would you rather do? Right? And my recommendation is do a little bit of both. But the important thing to know, because you're saying, oh, well, if I do that, I'm going to lose deposits. We're not seeing that. At least the data is not showing that, right? Even for these payers that are at the average, even below, we are not seeing elevated decay levels. So balances are sticky and rate doesn't seem to be an influencer today. Okay. So with that, in wrapping up, you hear us talk about, I think one of the most, not common, but a question that I've gotten a lot this year, more so than years past, is, what silver bullet strategies do you have? It's like, well, you wouldn't be listening to this webinar if there was one. There isn't one, right? And so I think just, it's a basis point game today, and taking ALCO and really transforming it from a historical perspective to forward looking and strategic will help change the conversation. Keep it simple. Simplify the reporting package, the results, do your pro formas, and at the end of the day, tell your story. Make ALCO a story. So with that, I've got, I think 1 minute to spare. Susan, I'll pass it back to you and the group.
Thank you so much, Joe. Great information. Hopefully everybody is able to find something to take back and use from Joe's comments today. Before we wrap up, and just in case people have another question or so that comes into their mind, I will take just a second to let you know, and I don't think Joe knows this either, but we just started a special advance offering today. So we emailed it out to everyone this morning. The special is on 2 years and longer bullets and amortizing advances. And so it's a 10 basis point discount off our regular rates, and it runs to the end of the month. So it's a good chance to lock in some funding, thinking a little bit about the future, and some of these loans that you're putting on the books, et cetera. So, but yeah, if you're interested in that, please contact your account manager or the lending desk, and they're happy to help you figure out how you could use that on your balance sheet, or to take the money down. So it will fund the day that you request the funding. So, and no limit per institution or anything. Sometimes we do limit it, and there is no limit this time. So welcome your participation or questions about that. Let's see. Looks like there's one question. Oh, it's Susan. I'm sorry, it wasn't a question. So Susan in the chat has placed the link to our survey. We'd really like you to complete that. It only takes a minute or so to do it. Just give us your feedback. So that helps us plan future webinars, and we appreciate that. Well, Joe, I think you've answered every question. There's no more questions. So, but I do know Joe put his contact information here on this last slide. We will be emailing these slides out at the beginning of next week, so that you'll have that. And feel free to contact him, I think he would say, if you have any follow-up questions, or if he can do anything for you, or get in touch with us. If you lose his contact information, we'll point you in the right direction. And we're always happy to answer any questions you have. So once again, I hope you found this useful today. And thank you, Joe, and thanks for coming, everyone, and hope to see you next time.
Thanks, everyone. Take care.